What are penny stocks and how do we trade them? Let's break it into two separate pieces. We'll start with what are penny stocks. Penny stocks are defined as securities that are traded under $5. Now, a $5 security may be exciting for somebody who doesn't have a lot of money in their account. It's like, hey, I can buy a lot. But remember, if a stock is cheap, it's cheap for a reason. If it's a good company with good management, good product, it should be going up in trajectory and be over $5. If it's under $5, typically there's a couple risks to you. Number one is they're usually not well-established companies. They're companies that people probably have never heard of. Number two is liquidity. Liquidity refers to how many people are buying or selling that respective security. If you have very low liquidity, that means if you try to buy some, you could move price yourself. Even though you're only buying a few hundred or few thousand shares of a penny stock, you could still move price dramatically. The other big risk here with penny stocks is what's called pump and dump. There are countless social media influencers that are telling you to buy XYZ stock. It's trading at 0.001, and if you buy it today, it's going to go to 0.01 tomorrow, and you'll 10x your money. Okay, what typically happens with these kind of, I'll call them scams or shysters, is they will issue this alert to thousands of people who follow their newsletter. They're buying it before they issue the alert to you, so they're all loaded up. You buy your shares when they make the announcement, and they're the ones selling you their shares. It's called pump or dump, and it just decreases your probability of success over the long haul. The other piece here is understand, why is something under $5? Because it's probably not a good company. It's probably not doing very well. Now granted, there might be some diamonds in the rough, but they are far and few between. Most of those penny stocks have a downward sloping trend that goes lower and lower and lower, and ultimately will probably get to zero. So your goal as a trader is consistency. Finding securities that give you a high probability of being on the right side of the trade based off the trend and other factors. With penny stocks, you have most likely what looks like a bad EKG, just extreme volatility because of the pump and dump, because of the low liquidity, and that, my friends, prevents you from being consistent as a penny stock trader. So you should be looking for more established companies like an Nvidia, Microsoft, Goldman Sachs, something that has tremendous amounts of liquidity and a very clear price chart that shows a nice, clear trend that you can join. That's part number one, what's a penny stock? Number two is, how do we trade them? My simple answer is, you don't. Do you want to get into this to be a complete gambler? Then go to Vegas. It's much easier to throw your money down on 36 on the blackjack or on the roulette table and just let it ride. That's gambling, and in my opinion, so are penny stocks. Every now and again, you might hit a diamond in the rough on your penny stocks and get a 100x winner, but you're going to have hundreds of losing trades until you find that diamond in the rough. It's much easier to focus on the big, highly liquid trending stocks, whether the trend is up or down, and that increases your probability of success. So, in my opinion, the key is don't trade penny stocks. Focus on price charts of whatever security it is that gives you consistency and can lead you to high probability trades, because that over time is how we will grow our accounts, with consistency. Now, if you'd like to learn more, we'd love it if you sign up for our YouTube channel or click the link down in the description to register for a free trading and investing workshop. If you'd like to learn more, we invite you to subscribe to our YouTube channel or register for our free trading and investing workshop using the link below or scan the QR code.